Hi, this is Logan Hertz with Hazeltine LLC. We have back with us again D'Andre Clayton, the founder of Clayton Financial Solutions. How you doing, D'Andre?
I'm good, Logan. How are you today?
Doing well, doing well.
Yeah.
So today I thought we'd talk about something that D'Andre has that is unique. D'Andre worked a lot in the past in the Medicare field, which
Hmm.
got him a lot of exposure to the senior community. And that gives him a very unique perspective because he has seen the results of decades of financial decision making and how that impacts people in their golden years. And so he has the benefit really of decades of hindsight from looking at how the financial decisions that people made affected them, how following these sort of standard conventional financial wisdom has treated people, and how they end up. Um, so D'Andre, with that in mind, you want to tell us a little bit about some of the lessons you learned, some of the things you observed from working with the senior community so much.
Absolutely. I would say one of the number one things I've learned from working with the senior community, and I think I've said this on previous podcasts about how I look at money and how it has three purposes. One of them is growing, one of them is paying off debt, and the other is protection. And really, protection became very important to me when working with the senior community because I started realizing what situations they were running into when they were younger, growing a family, and how those situations they ran into erase their investments, erase their savings accounts. The mentality for me going into it as a young kid, I was young when I got to Medicare. Obviously, I'm starting to get a beard, but I was a kid there, right? So um, going into it, I had a bit of a naivety into thinking that everybody who has been on Medicaid or who is in that source of life where there's a very limited budget or having to live off of a social program, that they didn't have a good life prior, right? That they didn't make a lot of money at any time, and that's the reason why they're on Medicaid. But once you go into Medicare, you start learning, oh, wow, there's different ways that people qualify for Medicaid. It's not always money based. Oftentimes, it's even based on health condition, like, so Social Security, disability, all those different things. It doesn't show the full picture to say, hey, Medicaid means you never did well in life once you realize that. And so seeing that, I had a client, I remember a client who had to refinance their home because she had MS, and the wheelchair that she needed was over $74,000. Well, they had to get it from refinancing the home, which means now they have an additional degree of debt. They probably added another 30 years to the loan. Um, but what if they didn't even have that degree of equity into the home? Where would they have gotten it from? They probably would have just dug into her husband's investments, like many of them do, because staying alive is very important, more important than how much money we can spend. When we're faced with life or death situations, these investment accounts don't mean anything to people. They'll give it up very quickly. So it puts into your mind, well, is there a way to get the effects of having coverage at a much lower cost barrier without having the taxes associated with it on top of that, where I can get the care I need, but I don't have to make a decision that hits me so hard down the rest of my life that I can't look at retirement as a reality, right? So that was just one of them. Just health problems was one of them. But then seeing parents who had very, very successful children, but the parent was on Medicaid. And of course, in doing some digging, finding that many of them were like, hey, this child was first generation college. Now I did well because there was a transition. There was a time when you could get a good job, work your way up and you never have a degree, right? And so they could make good money for some time, but all of their savings would go into, well, I want to make sure my kid does well. And many are not familiar with 529 plans and stuff like that. And the reality is when the market drops, so do 529. So that's a catch 22 as well. You're gonna need to draw money from something that has a sequence of returns risk, if you're doing that and trying to take care of college and all these different things. And did I mention over the past 20 years, college has gone up, tuition has gone up by 132%. So this is no small feat to take care of, actually putting a child through college at this point.
Yeah, yeah. So in that, can you infer, like for some of these people who ended up on Medicaid for whatever
Hmm.
reason, who ended up, in financial distress in their old
Hmm.
age, were there things that, were there financial decisions that sort of led to that problem? And was there something maybe that they could have done in hindsight that would have helped them?
Absolutely. There were cancer treatments, uh, different incidences where they had to get rehabilitation, all of these different things before they even hit Medicare age, and they just didn't have the proper coverage to take care of it. And because of that, they went into every investment vehicle and anywhere they could to get the money. Savings accounts, it doesn't matter. So that's the protection aspect, getting, and I think it's very important when I mention this about the protection aspect, because some people think, okay, well, and I've made a mention about the financial malpractice of Dave Ramsey in reference to this aspect, where he talks about being able to grow mutual funds to such a degree that you can basically self insure everything, right? Self insure long term care. Well, the reason why that doesn't make much sense, right, is once you use the money, it's taxable. It also creates a taxable event. So it's like, okay, well, yeah, you could say I self-insured, but now I have to deal with this huge tax bill on the back end. And where is that money going to come from? Right? Where is that money going to come from? And for many, it comes from the same places, or they just have a stack of huge bills that they never could get ahead of in the future. So having protection in place, which is an insurance policy, insurance is an aleatory contract, which means you always get out more than what you put in.
But
Uh,
DeAndre, I think some people are going to hear that and they'll say, "Yeah, I have health insurance, whatever."
oh, you said
Because
health
when you
insurance.
say protection, they don't know what that means. They're like, "I have
Right.
health insurance."
Right. So the nuances of health insurance is that it just doesn't cover everything, right? You can look into your health insurance plan and you'll see exclusions of what can be
But by
done.
the way, health insurance is not insurance.
It's
Like
the
what people think of as health insurance is not insurance. I just
it's
want to make that clear.
it's
It
not.
gives insurance a bad name.
Yeah.
If you are thinking that, hey, it's okay if I get cancer or something like that, health insurance will cover it, you're in
Oh,
for a rude
you're
awakening.
in for a rude awakening.
So
Um,
DeAndre, how can they protect themselves?
yeah, so one thing you can do, obviously, is using an insurance policy. It has critical illness, chronic illness,
So
all
you're
those
talking, but you're
things.
talking about a whole
Okay.
life
You
insurance
could use
policy.
a
When you
whole
say
life insurance
when you say
policy.
insurance policy, you mean
Yeah,
a whole life insurance policy.
absolutely. Absolutely. You
So
could,
yeah, this is something that a lot of people don't realize about the flexibility
right,
of a whole life insurance
right,
policy.
right.
Um, that death benefit can be liquid, right? So if you take out a whole life insurance policy with $1 million death benefit,
Mm-hmm.
typically, depending on which company you're working with, there are riders that are included at no out of pocket cost to you that will allow you to advance yourself that death benefit tax free should you
Mm-hmm.
have a long term care need, should you have a critical illness, should you have a terminal diagnosis, right?
Yeah.
In any of those circumstances. So think about if you want to quote unquote self insure, which that's kind of a contradiction in terms to be
It's
self-insured,
it's
right?
not possible to self-insure. Just
Well, and
like
it's not really, again, it's not insurance. The idea
it's
of
not
insurance
insurance. Yeah, it's
is
not.
I pay $1 and I get multiple dollars worth of coverage.
Yes,
Otherwise, why would I bother, right?
yes,
And if you're going to be self-insured, then you have to have money that's earmarked, right? You can't have money in the market and say that's going to cover me. You have to have
correct,
that money parked to the side in
correct,
cash where it's not at risk and say that's my insurance coverage, right?
correct.
But think about how long it would take you to save up $1 million in the market versus when you pay that first premium into a whole life contract with $1 million death benefit, you immediately have a
Absolutely.
million dollars worth of coverage, right?
Absolutely, absolutely. And I mean, even with using contracts like Peter mentions with those that are fraternal societies as well. I started off when I left the teacher market. I went into PTAs for some time because I was so used to schools, right? And I was using foresters at that time as well. So I'm well aware of the benefit of having a much smaller premium to be able to accomplish a much bigger problem, right? And a lot of people have not really wagered that and understood that concept as well as they should because of concepts like buy a term and invest a difference, so on and so forth. It just kind of makes them feel like, well, when I buy term, that's all I need in reference to insurance, which, obviously that's not really a good idea. You could argue, and I mean statistically, I'll say this. I don't agree with not having any insurance, but statistically, 99% of the time, if term isn't going to pay out, you could have saved that money too.
Yeah, if you really take that argument
Yeah,
of self-insurance to its
yeah,
logical conclusion,
yeah. You
you
could have
should not
invested that
have
as well.
you should not have any insurance.
Yeah,
Forget it. Like look at your homeowner's insurance policy. There's
exactly.
only a
Yeah,
4% chance you're ever going to
yeah,
use. So
yeah.
why don't you stop throwing that money away on homeowners insurance? Put it into the market instead. Get your phantom 12% returns, and you'll have a much bigger
And
pile of money available to you. And then if something does happen to
exactly.
your house, now you're self-insured
Right,
and you can cover it out of pocket, right?
right.
So it's sort of a reductio ad absurdum. Like
Yeah,
take that to its
absolutely.
logical conclusion. Take the idea of self-insurance to its logical conclusion.
Yeah.
There are people who have built up multiple $1 million fortunes, right? But
Hmm.
yet, DeAndre, for some reason, they still have homeowners insurance. For some reason, they still have car insurance, right? They don't
And they
drop it.
wouldn't go
No, they
without it.
could afford it. Like they
They,
could afford it,
they wouldn't go without it. They wouldn't go
right?
without
It's
it.
just,
Yeah,
it's a much less efficient use of capital, right?
correct.
Because if you're self-insured, what you're saying is I'm taking all the risk on myself.
Right.
As opposed to when you take out an insurance contract, you're saying I'm pooling that risk among
Hmm.
millions of other people. So now I'm just paying a small amount to cover me for a much larger amount. One
Yeah,
of the things I like to say
absolutely.
is offense wins games, defense wins championships. And I think what you're pointing out here, DeAndre, is in the vast majority of cases, the reason why people suffer a major financial setback is for health reasons.
Absolutely.
Something happened to their health.
Absolutely.
And they had health insurance and it didn't matter.
Absolutely. Absolutely. Yeah, that's the vast majority of situations, health problems either with themselves or their children or their parents milks them dry, right? And when it milks them dry, well, what happens? Well, okay, now I gotta just figure out this thing. I gotta budget because really life, psychologically, we have a fight or flight that's just in us naturally. So we're gonna fight. We're gonna fight, right? Whether we're making $1,200 a month because of everything we've lost, or we're making $5,600 a month, or we're making $10,000 a month. Our mentality is to survive. That's the thing, right? And we can't override that. So once survival is threatened from anybody from a health standpoint, and anybody listening to this, if your parents got sick today and they didn't have money on hand, would you try to keep them alive with your own money? Yes. Anybody listening today, if your children got sick and you didn't have money, cash, would you give up some money in your investment account to take care of them? Yes. If you got sick, would you not care about the 59.5 rule to use the money to take care of yourself? Yes. So the problem is we understand how humans are wired. We understand that the fight or flight will happen. So we should address these if situations as when situations, because even if, so let's just say, even if you never got sick, are you in a better situation if you were insured and you have cash value that was built up?
So and again, when you say insured, again, we're not talking about health insurance.
We're not talking about health insurance. We're talking about
We're
whole life
talking
insurance.
about a
Yep.
properly designed whole life insurance policy.
We're
I want to
talking
be
about
clear
a
on this,
properly
right?
designed whole life. Yep.
Yeah. Health insurance is not insurance. Fine if
No.
you have it. I mean, use it to the degree that it helps you. That's fine.
And man, it's some people having to pay a deductible of $7,500.
Yeah. Well,
It's not health insurance at all.
no, and of course you find out there's always some technicality where they end up
Right.
not covering you. It's a bizarre maze that nobody
Right.
can figure out, right? You know, and so the reason, one of the reasons why you can tell that health insurance is not insurance is because they don't underwrite you, right? If you want to
Mm,
take out a whole life insurance policy, they underwrite you. They look at your health, they run tests, and they will determine the risk level of insuring you, and they may not cover you, right? If you're not a healthy person, they're not going to cover you, right? Or it'll be more
God.
expensive,
You know
right?
what? I never thought about it like that. That is true. They don't underwrite you because there's no risk on their behalf.
So yeah, it's so in addition to whole life, there are other ways too. So the beauty of whole life is it's not use it or lose it. One of the reasons why I think people are resistant to buying an insurance policy, which I don't think they should be, but is they're like, well, it's just a cost
Hmm.
and I might not ever use it. It's like, well, then why do you have homeowners insurance? Why do you have car insurance? Just get rid of all of it then, right? Um, but
Right.
but that's sort of the hesitation is I pay money into this policy and I never end up using it, right? Well, I would say it
Right.
was still money well spent, right? Offense wins games, defense wins championships, not to mention the
Hmm.
peace of mind that comes with knowing you're covered, right? If you didn't have car insurance, imagine how you'd drive your car, right? Very carefully, right?
Hmm.
If you didn't have homeowners insurance, you'd have this constant worry in your head, right? Um, but with whole life, it's not use it or lose it. This
Yeah.
is the beauty of whole life. You pay money into that contract. It is available to you. It is liquid in terms of the cash value,
Hmm.
in terms of the death benefit, in terms of the long-term care rider, the chronic illness rider, the critical illness rider. But if you never use it, it stays with the policy. It stays with the cash value. It stays with the death benefit. And if you never use any of those benefits, you or your heirs still get all your money back plus more, right?
Hmm.
So it is not use it or lose it. That's part of the benefit of whole life.
Yeah, absolutely. And I would say the other part is, and I don't want this to sound bad because being in Medicare, I respect these advisors quite a bit, the final expense market. If a person really started to get whole life policies earlier on in their life and they stayed the course and allowed it to, basically take care of any of the problems that come up in life, um, it would negate the purpose of having a final expense policy.
Right.
And the truth of the matter is the buy term and invest the difference community can't really negate that final expense is a serious thing when by year 2030 they expect that there's going to be $240 billion of money spent in final expense, right? So the final expense market is huge, probably next to the mortgage replacement market, right? The 30-year mortgage term, whatever. The final expense market is probably the next biggest to that. And the reason why it's the next biggest is because once the term has ran out, these people still need insurance. So they think about burial, they think about all of these different aspects once they get to this time in their life and they're realizing, hold on, I don't have insurance. I don't even have anything left. I don't have an account to leave my children because of my health problems, so on and so forth. And now they're applying for what we call guaranteed issue life insurance policies. And there's nothing, and all of what I'm saying, I have nothing against either one of these products, but the reason why it has to be positioned is because of lack of planning in the beginning,
Yeah,
right?
yeah.
If
And
yeah,
one of the
uh,
things you mentioned earlier in a previous episode was how the number one concern with a lot of these folks is liquidity. So they
mhm,
put money into some kind of vehicle. Their concern is, can I get my money out?
mhm,
Right. And
absolutely,
one of the huge benefits to whole life is its liquidity, the ability to borrow against it with a policy loan without taking on debt, without interrupting the growth in the policy. So
right,
if you have money in an investment account or in a retirement account and you need access to that money, you've now interrupted your plan, right? And
right,
you cannot make up the lost opportunity cost of not having the money in there.
right,
You can pay it back later, but you won't make up for the gains that you
yeah,
missed out on. So if you pull 50,000 from your investment account, it puts a huge gaping hole in your plan. Whereas if you have that money in whole life insurance and something unexpected happens, you can take out a $50,000 policy loan. Meanwhile, the full principal balance keeps earning for you in
keeps
your
earning,
policy,
yep,
right? Even if you never pay that policy loan back, right? But then
absolutely,
if you do pay it back later, you didn't miss out on anything, right?
absolutely,
It's a
absolutely,
huge advantage. And one of these days, I'll maybe show a use case where here's what happens if you have your money in the market and you have to withdraw, as happens more frequently than people would like
more
to,
frequently than people want to admit,
right?
yeah,
Versus if you had it in whole life and you can just take out a policy loan and you'll see your plan was not interrupted at all.
right, right,
Whereas in the investment account or God forbid a retirement account,
yeah.
you just put a huge gaping hole. The cost to you is a lot. If you withdraw 50,000, the cost to you is a lot more than 50,000.
Yeah. And you know what? And on that particular point, I have this really in almost every appointment when people are looking for any financial advising on top of, because when we do the insurance policies, it's a whole layout. We're taking a macro level view of what finances look like, and really teaching them elements and principles that they should have already known, but nobody really slows down and takes the time to explain to them. So I'm always careful with how I position borrowing from an insurance policy, and I correct the person every time when they say, "So you're borrowing from yourself?" And I say, "You are borrowing against cash value." Anytime a loan is from, there's ramifications that are negative with that from. And they're like, what? And I'm like, okay, so if we compare borrowing from your 401k to borrowing from the insurance policy, what you'll notice is from the moment you borrow from your 401k, a repayment schedule is set up, which means your cash flow is changed because they take it directly out of your paycheck, right? They're taking a loan repayment directly out of your paycheck, which changes your paycheck, but they're also adding the prime level is about 5.5% right now. So they're adding that 5.5% interest, and you're repaying this loan. And I think a lot of people don't grasp this. If you're borrowing from a taxable vehicle, when you pay loans back to that taxable vehicle, technically you're already paying taxes. I'll slow down. A lot of people won't get that, right? So let's kind of use the idea of I borrowed $5,000. Well, I borrowed $5,000 from a 401k. Well, I'm going to have to pay the 5.5% in interest, but I'm also going to have to pay the fact that I'm paying the full 5,000 back shows that I'm paying taxes ahead of time. Because once I draw it, how much is $5,000 worth when I start drawing it? It'll probably be worth 3,500 or something like that by the time I start drawing it. So technically, you would almost be paying taxes twice, which hurts people on the front and the back end because they're thinking, well, this is a liquid place. Because a lot of financial advisors kind of position 401ks and because they have a loan provision, or they position mutual funds because they have a loan provision as
Right,
a
right. And
vehicle
it's
that
an
is
important
liquid.
point. It's an important point you're making because a lot of people just cannot think conceptually and they
Yeah,
cannot
they
make
can't think
distinctions.
that way,
So
right?
they hear loan, borrow against, like, oh yeah, I can borrow against my investment portfolio. I can borrow from a 401k. It's like, no,
No,
no, that is
it's
not at
not the
all the
same.
same thing. Not
It's
at
not the
all the
same.
same thing. When you borrow against a whole life policy, there are no repayment terms on that loan whatsoever.
Yeah,
Okay. There's no
and
debt, there's no liability to you, and your entire principal balance keeps earning. When you borrow from a 401k, you are now taking on real debt. You're not earning on the balance that you borrowed, right?
that's the next part that I was going to mention is the movement of the general account because the 401k doesn't want you owing them this money while it's still in the market and can lose. Right now, granted, it's good that you can't lose it now. If the market went down and you owed the money, and on that portion of money, we'll make sure that's clear. So on that 20,000, if that's what you borrowed, that money will not grow and it won't lose. But if you compare that to the insurance policy, you borrowed it, the money, the full pot is still growing at the same rate. So you'd have to say, okay, well, if I'm looking for liquid spaces to get money to protect myself, and I want to make sure that's clear, protect myself for the future, because a lot of times you actually harm yourself with taking these loans out
Right,
long term because you're
right,
harming your growth
right.
and you're harming your actual cash flow in the meantime because of the repayment terms that were forced on you.
Yep. And you're
And
taking
you're
on new
harming your
debt,
taxes because
right?
you just paid back a pre-tax vehicle or a deferred tax vehicle post-tax dollars on the loan.
A policy loan from a whole life insurance policy is a unique credit
It's
instrument.
very unique.
And we really have to hammer this point home because, again, I get it all the time. Like, oh, yeah, I could, in my financial malpractice series, right?
Mhm.
He's like, oh, yeah, you can borrow against an investment portfolio. I'm like, okay, that is a horrendous suggestion.
That's
That
a
is an
terrible idea.
incredibly high risk thing to do.
Terrible
You are
idea.
now putting your entire portfolio at risk, right? Read the terms when you borrow against your
Terrible idea.
portfolio. They're basically saying we can liquidate you for any reason,
Right.
anytime at our discretion, right?
Right.
You want to talk, the interest rate will be much higher. You might get 50% loan to value if you're lucky. So if you have
Right.
100,000 in the market, maybe they'll let you borrow 50,000. You've got real repayment terms. Like that is a high risk
Yeah.
proposition.
Well, on the
Yeah.
401k, that's kind of how it does. It's a 50% loan to value up to 100,000.
And what if you change employers with that loan outstanding? You know what happens then?
No, we're gonna stay with the same job forever. What you mean, Logan? We don't change jobs every well, nowadays they're changing jobs every 2 or
Yeah.
3 years.
So what I say is this: a policy loan is functionally the same as a withdrawal because there's
Yes, it's a
no required
withdrawal.
repayments whatsoever.
Yeah,
You contractually guaranteed right. There's no credit check, no nothing. Doesn't
yeah,
show up on any reports. Okay,
yeah,
and it does not interrupt the growth in your policy.
right. Correct,
So the
correct.
liquidity of a whole life policy is one of the strongest selling points. People who don't understand whole life get so hung up on the fact that now I'm going to imitate D'Andre Clayton, but when I pay a premium in, I don't have access to the full dollar amount in year one, right? It's like no, actually, so they get obsessed over the loss of liquidity because it is true in year one of a whole life policy, no matter how much, no matter how you structure it, you pay a dollar in premium in, you will not have a dollar of cash value
No,
available to you. It will
no,
be less
that's
than
true.
that.
That's
Now,
true.
eventually, it'll be way more, but not in year one.
Yeah,
Okay. Um,
absolutely.
but the liquidity of whole life, once you understand what that cash value actually means and the terms on which you can access it, you'll understand that the liquidity in whole life is one of its best selling points. There is no better source of liquidity than a whole life policy.
Yeah, and I think and oftentimes, you have the investment market fighting against the insurance market, especially on this particular point, they really down talk dividends, which for the life of me, I can't understand why they down talk dividends from a whole life insurance policy. Because if a policy is structured correctly, the dividends are a remarkable thing. I know some, and I make different designs. Sometimes I do 10-page designs, sometimes I go out to the full life, sometimes I do 20-page designs. But in particular, when I look at a 10-page design, just because it's easy to see how strong dividends are in a 10-page design, because once it's paid up for 10, after the 10 years, it's like, hold on. Oh, it's growing by 20,000 year 11, 22,000 year, and watching that happen over the course of a person going to age 95 or age 121, um, it makes you understand that when you hear the rhetoric around, for instance, withdrawal rates, 4% withdrawal rates, and different things like that, you're sitting there watching something that is continuing to grow up, even in years where you're using money. So I always call I call the whole life policy a spend up account, which is, fitting in any life insurance policy or annuity. Is better to call it a spend up account than to call it a spend down account. Because if you look at investments, they're really technically spend down accounts. You hit the timer, unless you want to be subject to sequence of returns. You hit the timer and you say, okay, how long is this going to last? Right? The whole life policy, you don't have to worry about how long it's going to last.
Right. You set that locomotive in motion. Now it's got its
Yeah,
own momentum,
yeah,
right? So you don't have to worry about when it's going to stop. It will
you
not
don't.
stop. It is a locomotive. It's pretty tough to stop a locomotive that's got momentum.
It's very
Um,
hard, very
and
hard.
then that makes people start to realize, why would I ever want to stop paying premiums into a whole life policy?
Right? Yeah,
Why would I not want to keep
yeah.
why would I not want to keep feeding that locomotive with fuel? Because every year it
Mhm.
gets more momentum. Why would I not want to pay a
Now,
premium?
I I'm gonna give you an idea. When you run a policy illustration, run a 10 and then run the payout to full life. Because what's going to happen is, if you run a 10, because conceptually this is so hard for people to grasp normally, a 10 is very easy to understand. Like, the dividend becomes clear, how it works becomes a little bit more clear because there's no more premium going in.
Mhm,
And
mhm.
then now you drop the whole
Yeah,
on
yeah,
them, and it's because that answer
right,
to what you're saying, as far as, well, why would I not want to pay into it my entire life? You could give them a taste and see, well, what if you just did it for 10 years? And they say, whoa, this thing is doing this after 10 years. Why wouldn't I want to? You can have them answer that themselves. Why
exactly,
wouldn't I want to pay this my entire life if it's
exactly.
doing this well? Or even if it's that, okay, it did this well, and maybe I drop premium at some point, but just keep the premium level for that entire time period. You'd be amazed at how much quicker a person could grasp that after seeing no payment going in. And the only reason why I do this, because a lot of infinite banking guys are not a fan of 10-pay designs. I'm a fan of 10-pay designs because it proves everything about the industry wrong. Right. And what I mean by that is, if you're meeting a person for the first time and they're thinking about an insurance policy, they're thinking about my money being locked up forever. I can never touch the money. Like, that's their preconceived notions, that there's no money that this thing can make. Cash value is available after year 7, and that's only going to be $2.30. Right. That's how their mentality is going to be driven. When they see a 10-pay for the first time, they say, hold on, you can have a whole life insurance policy that you didn't pay for your whole life. You'd be
Why don't you
amazed.
just show them a single premium mech, right? You don't even have to. You can just make one payment.
You'd be
Uh,
amazed at how many people, don't know that, though. Like, even what you're saying, a single premium mech, it's so many people who have never heard that. that they're like, oh, this is okay. I might need to take a step back. I didn't even know you guys could do a design like that. I thought I was on the hook for $20,000 forever until I was 800 years old, even though you're not going to turn 800.
Right. Well, so tell us two things, DeAndre. Number
Mhm.
one, reiterate what were the problems you saw that blew up in the senior community later in life? And number two, what could they have done? More importantly, what could they have done differently that would have avoided those problems?
Right. So the problems, and I'll take this from Caleb that I saw was uh, people were highly invested in ore, and that's all they knew. And they didn't know that there's accounts that can do and, right? That are really, really good for and situations. So I want to make sure it's clear, neither me or Logan are knocking being in the market per se. What we're saying is the market and your life doesn't mix. The market and life's problems don't mix. It doesn't mix it at all. It's oil and water. The market pretends that you don't have life problems that comes up. It only cares about what's going on with the companies that you're invested in, their problems, right? And that's how things are decided. So when I looked at these individuals' lives, I saw that there was a significant lack of just being insured. They didn't have cancer coverage, they didn't have stroke coverage. They had 60% of people, or both of their parents had cancer, and they never thought to get cancer coverage because what came up into their mind was, what if I don't get cancer? Most people swim in denial, right? Most people swim in that river of denial. So they are always focused on, what if I'm perfect, right? And we're imperfect beings. We go through life, we get sick, we die. That's that's the natural order of things. So if you don't prepare for the natural order of things, your investments will get eaten up by that natural order. And I've seen that happen so many times. Long-term care completely ravish a 401k. Long-term care completely ravish mutual funds and everything, because your fight or flight is going to turn on. You're going to try to take care of yourself. You're going to try to live, because living is more important than the money to you, right? In that moment, it is. Now, there's a survey that says that that 80% of seniors are more concerned with the amount of income than they or are more scared of running out of money than they are scared of dying. That's true until they get close to death. It's true until they get close to death. Once you get close to death, the only thing you care about is living, right? And that is something that happens so often for seniors, is throughout their life they've had these events that they realize, oh no, this is a problem. They blow up these accounts. They could have had insurance in place. They could have used the death benefit and accelerated it to take care of that problem, and still had life insurance afterwards that still would have paid something to their family after they taken care of the problem. Of course, I have different accounts to also do health matching accounts. That could be a very good discussion for us to have as well, for individuals, because it definitely helps with expenses. Um, but if you don't focus on protection, everything that you grew could go to negative in a second. Right? It could go to negative in a second. And do you have the money to pay the taxes after you've used it in these types of accounts that you have set up? Most people don't have the tax money to take care of it. So it's a downward spiral altogether that they're meeting, because when they're trying to survive, they're not thinking about, is this a good financial decision? I'll deal with that later, is what they're thinking about. I don't care what's gonna happen, right? And that's just for life or death. But there's surveys. I think I sent you a survey in reference to even school funding, which I mentioned to you. And there's an article by Lending Tree that says that 68% of people said that they would reach into their retirement savings to pay for their child's college. Now, I'm sure that percentage is going to go up as the tuition goes up. Because if the tuition is 132% more than it was 20 years ago, well, when it reaches 150%, I'm sure probably more than 68% of parents would use their retirement savings to make sure their children go to college. Well, insurance policy could fix that too.
You mean a whole life insurance policy?
A whole life. Thank you for the
Well,
correction.
I just want to be clear because we're sort of talking around
Right,
the
right. I
solution.
appreciate that.
We've
Whole
talked
life
about the
insurance.
problems, right?
Yes,
We want to now reverse engineer what a solution would be,
yes,
right?
correct.
And, there's not just one answer, but
Absolutely.
I think what you're saying is that in these cases where you've seen people basically lose everything by the time they get to retirement, it wasn't because their investments didn't pan out
No,
necessarily, right? It wasn't because
not
they
all
didn't
the
make
time. Yeah,
good income. It wasn't because they were necessarily financially irresponsible and weren't saving. It
no.
was become some negative health event
Mhm,
happened, right? Something unexpected happened and they had to dip into their investments, right?
mhm,
Or they had to dip into their retirement quote unquote savings, right? And that set them back to the point that they could not recover.
mhm.
So when we're talking about protection, we're not talking about health insurance, okay?
No,
That's
no,
not protecting you from anything,
no,
right? Not talking about health insurance.
no.
We are talking about a vehicle like whole life insurance, which gives you
Mhm,
savings, which gives you liquidity more so than any other account because of the policy loan feature, where you can access that money without interrupting the growth in your savings. That gives you long-term care protection, that can give you critical illness protection as
mhm,
well,
mhm.
right?
Absolutely,
Is
absolutely.
there other protection that they should have in place?
Uh, so so like I said, whole life insurance policy is going to be the best protection for the larger issues that could occur. And I can't even argue with using perhaps some of the fraternal benefit companies as well, who could add, a term that can do the same thing. It just won't have a net of money that they could use for like school funding per se, right? Um, so you could combine the two and make sure that you have all of those things covered. Um, I see you have umbrella. I also talk to a lot of my clients about umbrella policies because they're not that expensive, and it covers a great deal of liability as well. You
Yeah,
got
yeah.
estate planning. I love it, man. You got some good stuff here because we talk about
So
estate planning
it,
on
it
almost every appointment too.
it's proper order of operations, right?
Yes, I love it.
You would not, you would not start building a house and skip the foundation.
Absolutely.
Say, I just want to build the house as high as possible. Okay, well, the higher you want to build that house, the larger the foundation needs to be, right?
Absolutely.
And it's true that you're not going to see a lot of above ground progress when you're
Mhm,
building that foundation, but you've got to
mhm,
have the patience and the discipline to put that foundation in place first, right?
mhm.
People don't go broke out of fear. People go broke out of greed. They're chasing after these ephemeral returns, and
Amen.
that's how they get killed. Instead of following Warren Buffett, rule one of investing, never lose money. Rule two, see rule one. And when we're talking about never losing money, it's not just the market that's going to cause you to lose money. It's not having the right
Not
protection
having the
in
right
place.
protection.
And then, like Chris Kirkpatrick says, life does not exist on a spreadsheet. There's a huge psychological benefit that is not quantifiable to having the peace of mind to know I'm in good shape no matter
Mhm.
what happens, right? And then you'll have more discipline when you do go to invest because you won't have to chase those returns, right? If your investment portfolio is your plan for protecting you against long-term care, and it's your plan for leaving a legacy, and it's your plan for if a critical illness happens, and it's your
Yep.
plan for funding college, if it's got to do all those things,
It can't
that's
survive
putting
on.
a ton of pressure on one vehicle that was not designed for those
Yep.
things, right? It was not designed to do those things. It was designed for accumulation, right? It was not designed to protect you against a long-term care event. Okay.
Absolutely.
So you need to protect your assets, protect what you have first, right? Um, so there are other ways to do it. I think a whole life policy is the most flexible and should be sort of the bedrock vehicle that you start with. But as an example, there are phenomenal standalone critical illness policies that
Mhm.
operate like real health insurance, where they underwrite you, right? They will make sure you're a healthy person and they pay you a lump sum in the event you have a critical illness. Okay.
Yeah.
So it's very straightforward. You don't have to wrangle with a health insurance company over was this necessary or not, right? Because a lot of times, if you get diagnosed with cancer and you start doing the research, a lot of people decide, I don't want the standard treatment. I want these alternatives. And health insurance says, we're not covering that. What are you, some kind of
Not covering it.
crazy? We're not going to cover that,
Yep.
right? So you have health insurance, but they're not covering anything.
Mm-hmm.
Chris Kirkpatrick talks about his father-in-law. Okay.
Yep.
He thought he had twisted his ankle, went to the hospital, found out he had pancreatic cancer. They gave him 90 days to live.
Mm.
And they basically told him there's nothing we can do for you. We could give you
Right.
enormous chemo, and maybe it'd buy you a few months, but your quality of life would be so terrible it wouldn't be worth it. He had a whole life policy. He
Mm-hmm.
took advantage of the rider, the chronic illness rider,
Mm-hmm.
advanced himself multiple six-figure sums of money tax-free to pay for alternative treatments that health insurance would never have covered. 2 years later, he's playing golf 4 days a week. He never could have done that without his whole life insurance policy. Health insurance would not have covered it. No way.
Never in a million years. Yeah.
No
Man,
way.
that's actually why, and I'll add some more things to your list, because I think you heard me mention health matching accounts. I really, really love that product as well for the flexibility. The and of it really is, and a lot of people may not be familiar with it because it's not an insurance product; it's a financial product that couldn't become insurance because it didn't have risks associated with it. So what it does is it adds 10% to every contribution compounding for a 35-month period, right? So sometimes what I'll do is I'll set up an insurance policy for a client. And when they take out
Sorry, when you say insurance policy, do you mean a whole life
a
insurance?
whole life insurance policy for, I love it.
We do need to be
So,
clear, right? I mean, like,
yeah, so I'd have them take out a whole life insurance policy. They do an annual premium, and then I'll have them take out a loan and sit it in the bank account so that it can fund the health matching account, right? So that's two things that are being done. The dividend is still growing on the money that they borrowed to fund it, but the other portion is the amount of money for their health coverage is growing by plus 10% compound per month for 3 years straight. So imagine you're in month 30 and you're getting a 300% contribution match on your health coverage, on your health costs, right? So for those who are larger, my 725s, that's when it's giving you $60,000 of coverage across the board for however many individuals you want on the plan for 725 a month, and it's not insurance, it's cash on hand. So it allows them to say, hey, I want to go here that and get a LASIK, right? LASIK is not covered by health insurance, people. Not sure if you know that. Cosmetic surgeries are not covered by health insurance, right? Uh, Marital counseling oftentimes is not covered by health insurance. But an HMA could actually fill that place and take care of the cost of all of that therapy, so on and so forth. And it can build up and it could be used with either your mate, like it costs $5 to add a spouse. I mean, what insurance plan could you add your spouse to for $5? And it costs like 10 to add a child. And it's functional. You can use it for your dental, you can use it for your vision. I hate the insurance industry for this in particular. I will say this because I love the insurance industry, but I hate this about the health insurance industry.
Which is not health insurance. It's not insurance at all.
But it's not health insurance. I hate this aspect of it. I do not understand why insurance is broken down into health insurance, dental insurance, vision insurance. I wondered, when did eyes and teeth not become a part of the body? I've always been confused on that. So a health matching account definitely fixes that as well, and I think it'll be a great tool for you to take a look at eventually. We'll I don't, if you want to do a call on it, that's fine too, but uh, it can definitely help dampen the pain from prescription drugs and all those things. And a lot of my senior clients love it because they can kind of decide, well, I may not want to be on the supplement no more. They can decide whatever they want to decide at that point.
Yeah, yeah. So offense wins games, defense wins championships. And when you
Absolutely.
play defense, you have to play defense as a team. Okay, you can't just leave one position uncovered. You got to cover all your bases. So it's better to have more modest protection across the board than to have super robust protection here and leave something uncovered, right? If you have a
Mhm.
house and a car, you wouldn't say, well, I'm going to have really good homeowners insurance, but I don't need car insurance. I'm a pretty safe driver. I don't need to worry about it, right? You would have both, right? So
Yeah.
likewise, when it comes to having protection across the board, oftentimes there are opportunities to optimize your coverage where maybe we reduce the amount of coverage you have in some area in order to put coverage in an area where you don't have anything. So, as an
Hmm.
example, maybe we raise the deductibles on your home and auto insurance and use that amount we saved to buy a liability policy, right?
Right.
So, I'm big on optimization, optimizing what you have.
Smart.
So it may not even, people get worried about costs. Well, I wouldn't view this as a cost, a pure cost, but still, um, there are ways to optimize it, right? So that you
Yeah.
get coverage across the board. And one of
Yeah.
the assets that you need to cover, and this is a whole nother topic, is your insurability. Okay.
Absolutely.
If you have coverage through an employer, that's great. It's not protecting your insurability. It doesn't go with you when you leave or when the employer changes it or reduces it or removes it, right?
Right.
So if you have, as an example, disability coverage provided through an employer, great. I'm glad you have that. But what if you have some kind of a health issue, right? And you become uninsurable and then you move on to another employer, right? Now you can't get covered. You didn't protect your insurability.
Right.
If you're still healthy enough to get insurance, you need to make sure you have an individually owned, non cancelable disability policy such that you can keep it in force no matter what happens to your health. Critical illness policy, same thing. You want one that's guaranteed renewable for life. Otherwise, what's happening is it's not that you're not covered for disability or critical illness, it's that you're leaving a base uncovered, namely your insurability. So you got to protect all your bases,
And,
right? And
and
obviously, whole life insurance by definition protects your insurability because it stays in force for your whole life, no matter what happens to your health.
and to add to that point that you just mentioned about employer insurance, so on and so forth. A lot of people don't know that if the employer is the owner of the insurance policy, speaking about group plans, I'm not talking about Jim Harbaugh situation. I'm not talking about key person plans. I'm talking about group plans. The employer has the rights, right? So death benefits don't pay out that often if you're employed. It's less than 2% actually that death benefits pay out if you're employed. And the reason why is because most people don't drop dead. Most people have an incident that they have to kind of weather for some time, and maybe their health continues to just go take a downtrod. Well, in that time, if you were on FMLA or if you were not at your job, usually the parameter is 4 to 6 months, and you will become what is called an inactive employee. Once you become an inactive employee, you have lost that amenity of having life insurance coverage on yourself. It's conditional to you being employed by them, being considered an active employee. So even if you have a job and you don't ever plan on leaving, if you have an incident, a stroke, cancer, and you go out of work for an extended period of time, your insurance is gone. It's gone, right?
Yep.
Um, and
And
that's
you have
something
no
that a lot
ability
of
to get
people
it.
don't know. Yeah,
Yeah, don't treat this product like it's something you can get whenever you want. It is not.
it's not.
You have a window of opportunity while you are still young enough and healthy enough to get covered. So get it while you can. And even if you're not healthy, there are always options available. It's just maybe the best options are not available to you anymore.
Yeah, they're just far more costly at that point, right?
Yeah.
Um, you know,
But we can still make a more efficient use of your capital than, oh, I'll just put it in the market and that will cover me. It's like, no,
yeah,
there's always a
absolutely.
more efficient use of capital than that. Uh,
Now, I
for
want
the
to,
sake
if
of,
I can, is it possible for me to share?
yeah, go ahead and share.
So I want to show you this because I really appreciated your pyramid. And I think your pyramid and this equals the story of why people struggle when it comes to when it comes to their senior years, right? So now this talks about what is your top financial priority, and it measures mothers and fathers, right? So you mentioned that protection needs to be the foundation. Now, how many people look at protection as the foundation?
Yep.
That's sad. When you really think about it, that's kind of interesting that people are looking at life insurance, whole life insurance, and they're saying that I can take it or leave it at an above 90% clip, right? But when they're talking about paying off debt, well, no wonder they have so much debt. You could actually use an insurance policy to pay off debt. You can use a whole life insurance policy to pay off debt, right? You can use
Right.
that to pay off debt. We do it all the time in my practice.
Right.
Saving for child's education, you could use a whole life policy to do it.
Yep.
It can do these two things. Build an emergency fund. It can do that,
Yep.
right? Saving for retirement. Can a dividend grow at a rate that you can say, hey, that's better than a 4% withdrawal rate? It can.
Yep.
It can, if we're honest,
Yep.
and it can still provide you with life insurance to boot. And guess what? We're going to say something that's controversial. You can take a loan from an insurance policy and invest in the stock market.
Right. Run your money through your whole life policy first, then put it into the investment product. So to your
You
point
could
about
take
being an
it
and
from the
asset.
whole life insurance policy. And so when you look at this list and you see how people think, right? You're saying that people are chasing after the first thing is that they're struggling. This reveals struggling, paying off debt being the highest concern of the average consumer means that they're struggling. And we could look at the debt clock and see that people are struggling, right? Um, but why are they struggling? They're struggling because they don't understand money. They're struggling because they have a lot of their cash flow that's being taken from them every single month, and they really can't do anything about it because they're thinking that it's going to cover them on the back end of their life. And then when they run into these situations, now they got to dip into that money, right? Um, Now, this article, as I mentioned, it talked about 68% of people being willing to use their money for their children. And you're seeing that come true here, this 30 and 35% saving for my child's education. Um, but I mean, how good is a 529 plan after, if your child gets straight scholarships, how beneficial was that 529? you know, you know,
Right. And let's not confuse. I like what you said, D'Andre, about how they are allowed to misrepresent investments as if they are
yes,
saving. 529 plan is not a
it's not a
savings
savings
plan
plan. It's an
because it's
investment.
taking on risk. Same thing with
Absolutely.
401ks, same thing with all of these so-called
Yeah,
retirement savings or college savings vehicles. They are not savings.
they're not savings
They
plan.
are speculative investments where you are
Absolutely.
taking on risk. It is
Absolutely.
not a savings vehicle. Whole life
Absolutely.
insurance is a
Is a
savings
savings
vehicle.
vehicle.
You cannot lose cash. So,
Yes.
DeAndre, in closing, you want to just summarize the lessons you learned from serving the senior community and how people could potentially avoid those problems and end up with much better retirement outcomes.
I learned that people need money throughout their life, right? Even before they get to their senior years, to handle life's problems. And I learned that the easiest way to do that is to protect yourself from life's problems so that you don't have a huge windfall that hits you. Uh, and that just kind of makes the rain pour everywhere, right? And that's the gist of what I've learned of the 400 clients I have. It's sad to look at the state that many of them are in. Now, yes, I have some who have annuities and have investments. That's true. But are they the majority? Absolutely not. The majority are not doing well in this country. And we need to not fool ourselves by believing that that's the case. The majority are struggling, right? And the majority are still having homes that they have a certain degree of debt on. We're trying to help. I try to get gosh, what's this? I try to get Don on calls, and sometimes they still haven't paid off a great deal of their home in their 70s. In their 70s, that oh, the reverse mortgage possibly doesn't work for them in their 70s because they have not done a due diligence of what came first on their list. We saw what came first on their list is paying off debt. They're not even efficient at that. People at large are not efficient at that just because they also don't understand interest, which we've had that conversation on the HELOC uh, conversation, is that if you don't understand credit, you don't understand interest. Paying off debt is a dream to you. It's not going to happen if you don't really learn that correctly. And if it does happen, you've given up everything to pay it off to a point that your lifestyle is not going to be what Tom Heckner says. You not only want paychecks, but you want play checks. When people think of retirement, they think of Miami Beach. They think of enjoying themselves. They think of traveling. They think of doing all the things that they couldn't do while they were working, right? Because, if you were working, you had to take PTO off, right? So if you never get to that dream of being able to do that because of all the sacrifices you've made in between, why not just prepare for those sacrifices? Isn't that a good question? Instead of just investing, and hoping that something happens, prepare for those situations so that whatever you come through with is more than adequate enough on the back end. And if you don't get sick, if your kids don't get sick, if your kids all get scholarships and go to school without having to take a dollar out of their pockets, your retirement is even better on the back end because now all that money that you saved into a whole life insurance policy, you can still use. It's liquid, and you're not dealing with the taxation from using it. Right. So that's what I've learned in my experience because there's so many of them that, I do. Sometimes people say, well, DeAndre, you sell insurance policies. Why don't you, why do you structure the insurance policy so lean for people? What's in it for you if you're going to take so much out of your commission? And I tell them that there's a whole market of people that didn't make the decision to get insurance earlier. And guess what? Those policies I make a lot of money off of. I make a lot of money off of final expense policies. So it doesn't help me or Logan to tell you to get whole life insurance policy early where we structure it correctly and we take a hit on our commission. Now, it makes sense for us to tell you to get a final expense policy because I'm telling you, I could write a policy, and I've seen this with my own two eyes. I could write a $25,000 policy, and my commission on my $25,000 whole life infinite banking design policy is less than my commission on a $200 a month policy for a senior. That's the truth, right? That's what a lot of people aren't telling you. Most of the time you hear about infinite banking and it's always the whole, oh, those guys are just in it for commission. Well, if we was in it for commission, we would just be final expenses. Because there's more than enough seniors who are looking for insurance at all times, and we get 100% of the premium, right? For the first year, at least on our commission. So we're trying to help people to open their eyes to how the industry works, but also how life works, and being realistic, not being dreamers, but being intentional. And the whole life insurance policy is the best place to be intentional, to make sure that whatever destination you want on the back end of your life, you actually get there.
Yep. Thank you, D'Andre. And just to add a little bit to what he's saying, whole life is not whole life is not whole life is not whole life. You can't talk about whole life insurance in the abstract like you talk about real estate.
Correct.
People talk about whole life insurance and they're talking about policies with companies I would never work with, policies that are not designed properly, with people who don't understand how to use them properly. Or they get whole life confused with index universal life, with variable universal life, and they treat it like it's all the same when it is not. So you need to be working with a professional like myself or D'Andre who actually understands how this works, how to position it properly. Most importantly, we educate our clients so you will know how to utilize this product properly, and it's designed for you. There is no right structure in the abstract. There is a right structure for you.
For you.
Just like there is no right house in the abstract, there is a right house for you.
Absolutely.
So D'Andre, thanks so much for your time. Hopefully
Thank you, my man. It's always a pleasure.
All right. Bye-bye.
Always a pleasure.